Okay, so a very quick how-to on classifying when we've got all these different elements of the accounting equation together. So this is exercise 2 and it's actually on page 19 in book 3. So what we do when we look at these things is we decide first, is it an asset, an expense, drawings, liability, owner's equity, or income? So we look at equipment and we say, well, we own that, so it must be an asset. And then we have to decide whether it's going to be a current asset or a non-current asset. Now you might remember that current assets are those that we expect to turn into cash within the next year. And non-current assets are the ones that we expect to keep and use in the business for longer than a year. So equipment we would expect to keep and use for quite a long time, certainly longer than a year. So if we look at equipment there, we would classify that as a non-current asset. Then we go down to bank and we say, well, we own that, so it's an asset as well. And it's actually already a cash equivalent, so we're going to call that one a current asset. Then opening inventory. This is actually quite tricky because you think that you own inventory, but opening inventory we only use in the cost of goods sold calculation. So this is COGS. Purchases we also used in the cost of goods sold calculation. So that's how we classify that. Rent. Okay, so rent we don't own, so it's not an asset. It is a regular cost to the business. So you might remember those are expenses. So with rent we've got to classify it as either a distribution cost, an administrative expense, or a finance cost. So we ask ourselves first, is rent anything to do with selling or marketing the business? And it's not really. Then we ask ourselves, is it interest? And we say no. So it must be one of these administrative expenses, so AE. Then we go to advertising, and that's an expense as well, and you'll remember that that's got to do with distributing your product or service because you have to advertise in order to sell it. So that's going to be a distribution cost or distribution expense, depending on what you've learned. General expenses. So they're general, they're not specifically to do with selling, they're not interest, so they must be AE. Drawings. Drawings obviously are drawings, and depending on what you've learned, you might either use D for those, or you might call it negative OE. Wages. Wages are an expense. We're not told what type of wages they are, so we will just put those as AE. Shop fittings we own, so they're an asset. We don't really expect them to turn to cash in the next year because we're not planning on selling them, so they're a non-current asset. Okay, so accounts receivable is the next one. We would expect to get paid for the money that people owe us within the next year, so that's going to be a current asset to us. Freight in, we're using the calculation for COGS. Customs duty we use for COGS as well. And insurance is an expense, not directly to do with selling our product or service or advertising it. Not interest, so it must be an administration expense. Capital. So we're over up here now, and capital is owner's equity. So I'm going to call that OE. Sales. Sales is income for a business, and that's the main source of income, so we're going to put I there. Accounts payable is money we have to pay to other people within the next year. So that is something we call a current liability. Okay, so liabilities are things that we owe, and they're current if we expect to pay them in the next year, and they're non-current if we expect to pay them back in a period longer than a year. The next one is interest received. So we're receiving that money, so it's an income for us, but it's not our main source, so we're going to call that other income. And the last one we have on this little trial balance is loan. Loan is a liability because we have to pay it back, but we usually have to pay it back in longer than a year. So we're going to call that a non-current liability. The last one, which you may not have noticed, actually isn't in the trial balance, and it's down here. That's inventory at March 31st, 2012. That's our closing inventory. We actually use that in two places, so it's quite confusing. We use that when we're calculating cost of goods sold, and we use it in our balance sheet. In our balance sheet, we expect to sell the inventory, the product on our shelves, within the next year, so we call that a current asset. So there you go, there's classifying. Remember that your assets, liabilities, and owner's equity all go on your balance sheet, and your income and your expenses go in your income statement. So, good luck with that. Hopefully it helps, and talk to you again soon.